Welcome to Your Time, Your Money, the show where your time is just as valuable as your money, and we know that. Thank you so much for tuning in today. Excited to be here today. We have a guest on our podcast today, so it should be a great episode, right?
It's going to be an
Trillo?
amazing episode, Mr. Ashley. I'm super excited.
Yes, and we are here with Therese Wolfe with UHY Advisors, basically a CPA firm, and we are very excited to delve into the world of tax and tax planning.
Great.
Not necessarily the most, the thing you think of the most when you say, hey, let's have a good time and a good conversation.
I love talking about it. It's going to be fun.
We're gonna spice it up. We're gonna try to keep it spicy for everybody.
Yeah, so I'll do a little intro, and then Therese, if you want to, just chat a little bit about maybe your past history and what got you into this field and kind of maybe some of the areas that you specialize in. But we were chatting earlier, and you're in your 27th year of tax planning, so you've seen a lot of changes, right? You've seen a lot of changes.
Yeah, how do you do this for 27 years, but you're only 40? How does that work out?
Exactly. Thank you very much for noticing. Yes.
I'm sorry.
From actually across the river of my neck of the woods in Greene County, you're in Dutchess County area originally, but you're in Hudson, New York.
That's
so
right.
We were saying the whaling community, everything
right.
centered around whaling down there. And
Mark knows some really weird stuff, man.
Hey,
I didn't know that. I'm still learning. I'm
you gotta
so
learn
young.
Now
things.
you know.
I feel so
You gotta
young.
learn these things. She's also paid her last tuition check for her youngest son out of 3.
Oh,
right.
So this is-
college is over.
Yeah,
College
little
is over,
congratulatory.
There was a dance that was done. Yes.
Now you can start putting fish tanks in your house, and you can start buying weird stuff that you don't need to spend money on, but you're gonna anyways. It's gonna be great.
I hope not.
So as we get in there, we're gonna obviously get into some common mistakes, maybe things that people miss on their tax returns and stuff like that. But you tell our listeners a little bit about kind of what got you into the field and what made you stay in the field, and
Sure.
to where you're at today.
Okay, thanks, Matt and Mark. It's nice to be here. I love talking about this stuff. We could do it for hours. We won't, but we might. As you mentioned, I'm a CPA in the state of New York. And I got into it actually during college. I took an internship. I wasn't really sure what sort of the business field I was going to go down, and took an internship with one of the big 4 firms and loved it. I loved talking to clients. I loved figuring it out. So it just sort of went from there. It was a great profession to have as a working mom, quite frankly. It was nice to be able to have a really busy tax season, take some less intense time during the summer.
Not be able to breathe for about 3 months or so.
You probably do that early in the year, then get a little extra time in the year. So, but for me, really, I have clients that are, older retired couples that are just sort of day-to-day financial type decisions. And I have great, big, enormous clients with massive amounts of wealth, and I get to talk to them all on the same day. So I love that. It's a people profession, and so that's what's kept me here. And like you mentioned, I'm down in the Hudson Valley. We have 3 offices in Hudson, Catskill, and Kingston. But it's working with the people I grew up with. As you mentioned, I grew up in Dutchess County, so that's neat. It's getting to see 2nd and 3rd generations of businesses too, which I really love. So yeah, that's what's kept me here.
Nice. Well, it's funny because I heard once that you could have 8 different CPAs do a tax return for an individual, and all of them could come up with a different number, but it's still legal and correct.
That's right. We want to always stay in the confines of the law, but a lot of people get really frustrated when they'll ask us a question and we say, well, it depends, right? So there is professional judgment that goes into a lot. Most things are written in the law, but there's some things that are open to professional judgment, particularly when filing, your compliance returns. Yeah.
And the IRS isn't like, Big Brother over back looking to get you. They want to make sure that you're completing your tax return.
Yeah, they just want you to do it correctly, right? They just want, it's all our duty. Everybody's got to do it. So it's really,
I saw this great video where it's like, where they're like, okay, we're the government. It's like, we know how much you made and we know how much you owe us, but we're not going to tell you.
You have to figure it out.
And if you give us the wrong number, you're going to go to jail.
Hopefully there's no going to jail. There might be some discussion with IRS, which is also part of what we do, but hopefully there's no going to jail. But certainly there's professional judgment, as I mentioned, that goes into all of these individual tax returns, business returns. And so that's where you want to find someone that you trust and that you can, have open and honest conversations that can come up with the lowest tax possible, while still maintaining integrity and what we do.
Yeah, we get asked a lot of times, why should I use a CPA or why should I go to a CPA? And my response is always, the tax law is always changing.
Right. That's the biggest
So
reason.
if you're not
Every year.
educated and up to date on it, you're missing out on things.
Yeah,
So you must see that quite a bit.
All the time. Unfortunately, people come to us thinking that, oh, we're just going to hand it over to someone and then that's it. You know, I'm absolved of all sins.
There's
whatever.
there's no questions
There's no
or
responsibility.
answers.
Right. And that's not true, but it is working with someone who can say, oh, by the way, did you know this changed? Or, oh, maybe we need to think about doing this in 2 years rather than next year because we know what laws are supposedly coming down the pike, right? So that's the biggest reason. And also it's a stress that some people don't need. You know, I can't change my own oil in my car. I don't know. I could go buy oil.
Go to the professional. I always do that.
Stick it with what you're good at.
You broke your arm. Are you going to go to Wendy's to get checked out and make sure that you're good? No, because they don't have an MRI machine and they can't set your bone in your arm, right? And you go to a doctor. I want to ask you a question about CPAs that dabble sometimes as advisors, because this happens a lot, where a CPA will see a client, they'll come in, they'll do their tax return, and then, you know, over time, you'll see a lot of A shares building up. You'll see a lot of investment advice that also goes with the tax planning. Is that something that you see a lot of with CPAs, or do you guys shy away from that and really just strenuously focus on tax planning?
Yeah, so
I always like to know that.
Yeah, the way we've set it up is more of the stick with what you're really good at, right?
Yeah.
So we certainly have divisions in our firm that we can point people to. We have experts that work on that, but you know, we've done things. So for instance, another example is, say, you know, 10 years ago, we used to do payroll tax returns for clients, right? And they said, wait a second, hold on. That's an entire different set of laws. We're going to put you over here with people who just do that. Let's focus on what you're good at. And so I don't do that, and the CPAs in our firm generally don't do that.
Okay.
We like to connect them with people like you guys.
Well, it's also a series of checks and balances, right?
Well, I always like to ask that because it's normal as a client comes in, like, oh, hey, by the way, I have the statement. Can you look at it, right?
Well, a lot of times clients think that that's just part of what we do, right? So they think that we're doing those financial projections and planning when really we're focused on compliance most of the time.
Well, even some attorneys venture into that, you know, advice category as well, too.
Right.
You know, and unfortunately, in some cases, it's a disservice to a client because of all the ancillary things that you need to look at with it, right?
Yeah. I think it's better when we work in conjunction. You know, we work together. So in other words, they're going to person A for that type of advice, and then it comes back to me to say, okay, can we talk about the tax effects of what we just talked about, or do you have another perspective? Yeah. I tell this to my clients all the time. Sometimes the tax reason for doing something is not the best reason. You know, I see it as a tax decision, but there's 10 other things that they need to consider when they're making these decisions, and they need to speak to you guys. They need to speak to their attorney. They need to speak to their family, their extended family. Right. So we're just one piece of the puzzle.
And that's where this gray area is of giving tax advice and financial advice and legal advice, right? If you're an attorney or whatever, of trying to be, you know, that kind of that three-headed monster all at once.
Right. Yeah, and we're very careful too, especially on the legal side. You know, we cannot give legal advice, obviously, and so we're very, very careful. There's a fine line between CPA and attorney. We never want to cross that line, always.
Yeah, and I always tell a client, like, you know, look, in the CPA world, your goal is usually to get people a lot of money back for the year, right?
Well, just to have them pay the
least amount of tax,
the least amount of appropriate
taxes. That's a really tricky. It's a sticky sentence.
Yeah, you know, but you can also define that down to the least amount of taxes. Can also be construed as the least amount of taxes over a lifetime, which is drastically different than just for the year.
Exactly.
Right, through Roth conversion or setting somebody up so that maybe they're in a position where they pay little to no taxes for the last 20 years of their life.
Here's a great example, right? Let's say, Mark, you work and you're full-time and you have a 401k, but your wife stays at home, right? An easy thing, I'm guessing you've probably seen this before, but an easy way for you to mitigate your income would be to do your wife's traditional IRA contribution because she doesn't have a job. Right. Because you have earned income. Right. And it's like, that's like one of the best loopholes what a tax consultant ever taught me was I was like, oh my God, like I was like, what? You could do an IRA and this was like 10 years ago, you know? So whenever I have something like that happen, I'm like, hey, here's a really easy way to save $2,000. Right. You know? Quick and easy. And you can do it after the deadline, end of the year, before the tax deadline. It's interesting that you bring that up, though, because especially over the past couple of years where we've had these really low tax rates, you know, we've given advice that sometimes that we might not have given in the past. So now we're usually trying to defer income, accelerate deductions, right? Well, in the past couple of years, we've actually sort of said, low tax brackets.
Maybe we need to accelerate some income now because over your lifetime, like you just mentioned, we're going to lower your lifetime tax, maybe not this year's tax, But
Yeah. Well, maybe you
overall,
could speak on that a little bit, right? Because 2025 is the sunset of this current tax
Tax
code.
Cuts and Jobs
You know,
Act, yeah.
for the average listener, what does that mean for them? Like, what potentially can they be looking at? I mean, obviously, we know that could be extended. It could be
Right.
changed altogether.
Right.
But as is now, it's going to expire and go back to the older rates.
It is. So higher tax rates, and probably the biggest, I would say, just that the most people would fall into this bucket is the Tax Cuts and Jobs Act expanded the standard deduction. It greatly increased the standard deduction.
Right.
So
Yeah, it went from 6 to 12,000,
yeah,
right? And then married was 24.
Right, and
Yeah.
then adjusted for inflation ever since, so it's even higher now. So, there was a lot of talk back then during that time of my charitable deductions don't matter anymore.
Right.
So technically they are still deductible, but most of the time the standard amount captures the most.
So for listeners out there, what
Mm-hmm.
that means is that if you're not itemizing your deduction, you're taking the standard. So if I'm a married person,
Mm-hmm.
then I get the standard deduction for a married couple, which is $26,000 or
$20,000-ish,
$27,000.
correct.
That comes off my income. But
Right.
if I am going to itemize,
You need to be above that amount.
then I need to have more things that I can
Right.
write off
Right.
credit. There's words. I'm in the gray area. Thank God Therese is here. Right.
Yeah, so right, and those things are those in general. Those things are your medical expenses,
Right.
real estate taxes, or state
Business
taxes.
overhead, right? Cost of business.
Nope, that's separate.
Oh,
So
that's
that's in a
something
different
different?
bucket. That's in a different bucket.
God, we have a CPA here.
These are your personal things, and so your mortgage interest and your charitable contributions.
Oh, okay.
Right, but here in the state of New York,
there
everyone
cap,
there's
right?
a cap
Cap-
on the amount of our
10,000,
taxes we
right?
can deduct. Right, $10,000. So
Yeah.
See, I read stuff.
Yeah, well, so when listeners hear this, they hear SALT, right?
Right.
They like the SALT rules and stuff like that. And a lot of listeners like, okay, salt and pepper, like I don't understand what
Right.
this means.
Right.
But that's the cap that's put on us.
Right.
Correct. We used to be able to deduct all of our state income taxes that we pay
Yeah.
and all of our real estate taxes that we pay, right? So think about us here in New York State. Generally, that amount is greater than 10, so it's called a state and local tax cap, meaning we're capping that amount at $10,000.
Right.
So again, when you take that limitation and the higher standard deduction amounts, most people have just enjoyed this. We'll just take the standard for the past couple of years.
And that's going to change in
It's going to
2025?
change in 25. It's supposed to, yes.
It's going to go down?
That standard is going to go back down.
Okay.
And so now we have to remind people again, start adding up all your charitable contributions. Let's look at your medical again, or,
Well, I mean, I think you see the train coming in the sense that, taxes have been low for a long period of time, and the standard deduction is high enough to where people who are itemizing haven't been.
correct.
But it's also ingrained a habit in them of not saving the receipts and
Right.
not saving
Or
all those itemizations.
maximizing their 401k, 403b.
Sure.
Yeah, and if
contribution.
that changes, people are now, in
Right.
the habit of not
I don't
saving
need those. I don't need those
and stuff.
receipts, right?
Right. Yeah,
you know.
I started to, this tax season in particular, started to tell people, listen, we've got one more year of this, but that doesn't mean you need to ignore these things. We're going to have to start looking at them again. And chances are, who knows what will happen if it's extended or some version of that will change, maybe. But what it's also done is allowed us to do things. We talked about this before. We're able to tell the Roth conversion is out there, and again, that we were always hesitant to do that.
So many people don't take advantage of that, and it's like when we talk to clients, we always say to them, if we're going to do a Roth conversion, then we're going to hear from your CPA first.
Yes.
Because we need to know what your adjusted gross income is, or what your
Right.
IRMA is, if you're in the Social Security world.
Yes.
To know that we don't blow something up in your
Right.
plan.
Well, and we've had this conversation before the last time I was here. What you need, what does that do to other things? Your IRMA. What does that do to if you are an itemizer? What does that do to the threshold where you can deduct your medical expenses? There's a lot that goes into it. Not just is the tax rate lower or
And
higher.
even, and even per state, right? Because what does it do to your STAR program?
your star,
Right,
yeah.
yes,
To your-
there's
to your-
just-
yeah.
A lot of things to think about.
Yeah.
So that's why you should use a CPA. So many people
Yeah.
use TurboTax, and I'm just like, man, I know it's a little more expensive, but use a CPA because you're just going to get more benefits.
Yeah, and I think something we've come up with as a terminology in the past, which I think is portraying taxes, is it's a tax domino.
Oh,
You know
yeah.
what I mean? And
Oh,
if
yeah.
you get the first one wrong, it affects 3 or 4 or 5 dominoes down the road.
Yes.
And we want to make sure that we're avoiding the tax dominoes or spreading them out so that they don't make the other ones fall.
Here's a great question. Let's say someone was a TurboTax person and they come in and they drop off their returns.
Sure.
What do you normally find for that TurboTax person if you go back 3 years? What do you normally find for that person? Is it worth doing it? I guess is a better question. If I'm the lay person and
Yeah.
I have a job and my wife has a job and we have 2 kids and I've been just doing TurboTax, right? Is it worth me saying, you know what, I need to go in and see Therese
Yeah.
or
So-
a CPA?
It's sort of 50-50, right? I don't want to get myself in trouble for saying
No,
this,
I mean,
but-
listen, I just want to know because our listeners might
Those are
wanna
winning
know.
odds at a casino, by the way.
By the way, it's better than Rivers, okay?
Well, and I say that is because it depends. If you're just I hate to, if you just sort of have the standard source documents, you're employed, you have a W-2, and it can ask you some general
Basic
questions.
stuff.
I think you're going to be okay. But when you have, there's special circumstances. The situation I'm in right now, we're talking about with your children, when they're going to go to college, they're in that college year, they're just graduating college. Those are some tricky 4 years
Right.
in terms of
College
determining
planning
and college credits and who's dependent and things like that. We often see mistakes when it's a split family arrangement. Who's sharing the kids? Who's claimed the children in certain years? So we go back a couple of years and we think, "Ooh, shoot! I
Should
wish
we have done this different?"
Right,
Yeah.
exactly. Those are the common things that we find. Or if you're in a situation where things are going to be changing,
Right.
then I feel like something like TurboTax. I don't want to speak ill of them, but is not
Well,
going to
just
help
in general,
you sort
there's
of
other
look,
stuff
right,
out there.
Exactly.
There's Intuit and all this other stuff, yeah.
It doesn't really help you look, like you said, determine what those dominoes are are going to start.
What do you find are maybe the big one or two misses for either a tax credit or deduction that people don't think
Or
about
write-off.
when they come to you?
Deduction, credit, write-off. I couldn't remember the other one.
I think one of the biggest ones that I see, I wish that people knew more about, was when you're in your RMD years. So we're talking to a specific demographic right now, but when you're in your RMD years, I wish people knew more that they can take those RMDs and get them directly to the charities. Again, because of this,
qualified
qualified
charitable
charitable distribution.
Yeah.
Check out that episode, by the way.
It's a very good episode.
Oh, did you have one? Oh,
Yes,
I'll have to
yes.
listen.
We pretty much had episodes on everything.
Okay, there you go. I love it. But I wish that they knew that, because, like I said, with that larger standard deduction, maybe they're not truly getting the benefit of those charitable contributions, but they would have had they done it through the distribution from their IRA. So that's one big one that we see missed. A lot of times we'll see people say, "Oh, I sold this, but I don't think it really mattered," and so we'll take a look back at their documents and say, "Ooh, yeah, that really needed to have been reported." Those are sort of the things that we find.
What are your thoughts on I know there's a lot of talk out there about hitting people with capital gains prior to realizing them.
Mm-hmm.
What are your thoughts on that? Is that going to happen? Is that going to be something that people should stress
I
about?
wish I
Because
knew.
I've gotten
Unrealized
questions.
gains.
Unrealized
So, like,
gains,
imagine
yeah.
you're in the investment world, either it's qualified or non-qualified, so IRA or individual account,
Right.
and I've got a gain. It's been spoken of that the government says, hey, by the way, even if you didn't realize that gain, you're still going to pay taxes on it. Have you heard anything on the pipeline? I just want to know from someone
that would scare the heck out of me.
Oh my
actually.
God, yes, that would be very scary.
No, I haven't, and I'm pretty nerdy, and I keep kind of close tabs on
Okay.
that. I think they'd have a hard time getting that one through.
Oh.
But you know what? That actually reminds me, though. That's another thing that we see happen all the time is clients will come in and I'll say, "Oh my gosh, did you know that you did X, Y, or Z?" And they said, "That's okay. I lost a lot of money in the market last year, so I think it's going to offset each other."
Balance,
So
right?
either they didn't realize the loss, they didn't actually sell that asset, and or it's in their IRA, so
They
obviously
can't
not
realize
helping.
the loss.
Or they're thinking of offsetting ordinary income with capital losses. You know what I mean?
Yeah.
So
Doesn't
they
work
just
like
sort of
that.
come in thinking, "Oh, I don't have a tax liability, nothing to worry about." So those are some other common things that we see.
And then tax codes or tax changes always take, in some cases, decades for people to realize either the benefit or disadvantage of them. I think back to 98 when I was investing and the Roth IRA came out, and people didn't understand it, and it was really a good 10 years or more before people were like, "Oh, I should be putting money
this is
into
powerful."
this." And,
Right.
and that's
Yeah.
a decade of lost time.
And
I think the big one that's out there now that people are starting to find out about, but maybe don't even know about, is the way that they changed the inherited IRA laws for non-spousal beneficiaries. Can you talk on that a little bit? Because I think that's important. A listener understands that, because there could be somebody listening right now that lost their parent last year or the year before, and they move the money over, but they don't realize what's they have to do with that.
Right. So there's two things I'm thinking of. I just want to make sure I'm talking about the right one. But so when you've inherited an IRA and you
Non-spouse
a non-spouse, right? Well, you used to be able to defer that and just push it off. I'll worry about that later on.
Say I'll do it down the road. Yeah.
Right. Now we have to get that money out within 10 years.
Correct.
So a lot of people, again, with these lower tax rates, I wish more people were thinking, let's take it. Let's pay the tax now rather than deferring it. But I always say, of course, I always defer to you guys to say, well, there might be an investment reason for not doing that. But certainly from my perspective, I think let's get that out. Let's pay the tax now.
And what happens if you don't take it out? Let's say I do inherit my dad's IRA, and then 10 years later I haven't taken it out. What happens?
Oh, you're penalized to the
It's
tune
pretty
of about
bad.
50%.
50%.
50.
Yeah, I think
50%.
But I think the bigger risk is that in that
Period of time.
that period of learning the law and the knowledge of it, getting it out to the public, because the IRS and government does such a poor job of disseminating changes, is in that period of time you've lost 3 or 4 years by the time you find out you have to.
Holy smokes, I
Right.
have to take it out.
And with
Well, now you
market
need to
growth.
take much
Well,
larger
yeah, with market
distributions.
growth,
Right.
and then
Yeah.
now you're in a 6-year window where you got
Yes.
to take it all out, right?
Right. So now you're
and
bumping
you could
yourself
be,
up.
and if you're retired or you're in your 60s, you could then be affecting your Social Security benefit.
Everything. All
Right.
of those other things that we talked about.
So that's why it's really important that people understand there's a reason why there's two sides of the coin.
Yeah.
And then ultimately we have the attorney on the other, the other piece to help us
Right.
govern where all this stuff goes.
So usually when that happens too, it's, someone's passed away, so people are upset. And
Grieving,
right.
emotion.
Exactly.
Yes.
It's an
No, I
emotional
hear
time,
ya.
but it's that time when you start to reach out and say, okay, this is coming down. Those are the things that we can help with.
Yeah.
Good.
So, from a listener standpoint, I know we're past tax time for most people right now,
Thankfully,
right? So
yes.
we can take a
Can
breath
breathe.
and
Yeah.
relax a little bit. But, leading up to that tax time, what are maybe some of the big, like, I want to say pet peeves, but pet peeves that clients can avoid
Where's my documents?
what the clients can
Yeah.
avoid with dealing with a CPA? Because, you're working with hundreds or thousands of individuals in most cases.
Right.
And everybody needs to be aware that there is a lot of pressure on a financial professional, a CPA, during those really limited days
Right.
that you have to file.
Yeah.
And I would imagine one of them has to be the late documents, people getting
that's
things
the
to
number
you.
one thing. Yeah, it's funny. I've spent an absorbent amount of time trying to figure out how the IRS could do this differently. How could we take and structure this so that it wasn't, the 85% of our work didn't happen in 3 months, basically. But that is the biggest one. Probably, that people think, I have till April 15th. So in their
Right.
mind, they are thinking
Yeah.
they have until April 15th. And just sort of thinking about all the things that has to happen before then. So, I always say, get them to me as early as possible so that we can actually think of things that we hadn't thought of. When we get a document on April 13th, our only thought is we
Let's
have
get
to
it
get
done.
it under a return. We got to get it out of here.
Yeah.
We're not, so, and perhaps later we go back and give it a little bit more thought. But the more time we have to think about things and have these conversations, the better. So late documents is one. It also gives us less opportunity to talk about the things we were talking about with when you have children of a certain age. Wait, where does it make most sense to put these children? Do they have to file their own tax return?
Right.
Yeah.
A lot of times people just send in a stack of documents and then you're going through them and, I have 2 other returns in here. There's a child in there. There's a parent's in
Yeah.
there,
Yeah.
Or my favorite, which I told you we weren't going to address, is do you have a second for a quick question?
Do you have a quick question? I got a quick question. 45
Very quick
minutes
question.
later.
There's no such thing in the tax world as a quick question.
So what would be the best thing for clients to do then? Is email it?
Yeah, we have, right now, obviously, we have electronic portals. We can email documents. We have great software out there that organizes documents for clients. It's much easier than it used to be. We used to have clients come in with envelopes of paper and information. So much
The
easier.
shoebox, everything
Oh,
crinkled
we
up,
have-
rubber
I
bands.
I still have
Like
a
that.
shoebox
Kapow!
guy.
And it just explodes out, right? It's like confetti.
I still have one client that actually brings it in a shoebox to try to be funny every year. I hope he listens to this.
That's great.
But yeah, the earlier there's a lot of great tools electronically that we have that get documents to us electronically.
Yeah.
And a lot of the other thing people think is I don't have everything, so I better wait.
I better wait.
right?
Wait till the end.
Better
yeah.
wait to the end. And that's a conversation for you and your CPA. Everyone has a sort of a different style, but in general, I could say that the sooner getting it to your professional, the better.
Yeah, because if your staff can have data entry done for 99% of the
Yes.
return, and you're
Right.
just waiting on that
Clicking
one
on
thing,
one button.
Yes.
Here's my
That-
student loan payment.
yeah, that's
right
better
done.
than April 14th getting the shoebox
Well,
and saying,
and not only that, think about it from the client's perspective. They're not expecting a tax liability. I'd rather tell them in February or March, oh my
you're
gosh,
gonna owe
did
$3,000.
you realize that
Yeah.
you have a tax liability
Yeah.
coming up,
Well,
rather than on the 13th when you need to turn it around.
For the past 5 years, I feel like the last year has been pretty bad on especially middle class Americans with how much they're paying back, how much they owe, and I've had a lot of those conversations, and I feel like combined with student loan repayment and soaring credit card debt and
Sure.
people
It's
not being
hard.
able to pay their bills, now hey, by the way, you owe the state $3,000.
Right.
but let's talk about the why of that.
There you
Right.
go.
I was just
And
going to say,
and-
there's a reason for
And
that.
this is where the financial advisor is at fault sometimes, and it's the capital gains the last couple years that mutual fund companies have decided to take
because of the down market
in both a down market and
Yep.
an up market that have kind of pushed that, I'm getting some money back.
More
to
money.
now I'm owing
I'm
$3
owing
grand,
money.
$4
Correct.
grand.
That's always an interesting conversation, but at least there's a why, right?
Right.
It's a hard. We talked about this last time too. Is when they're upset about owing some tax, it's a hard conversation to turn around and call your advisor and say, "I'm so angry. You made us money.
You made us
Yeah.
$90,000.
But when the market's down and that happens,
Yeah, so that was a big thing in 2023 was that the market was down. It was a bad year, or was it 2022? 2022. It was a bad year, and every mutual fund company out there was writing off their books.
Yeah.
So everyone got hit with cap gain, plus they lost money.
but not everyone. And that's where
good
good
chunk of
financial
people-
plan
Right.
comes in,
Yeah.
is making sure you have tax management
Yeah, of course.
within your realm of non-qualified investments, right?
Yeah.
Well, the other thing that happened too is when they passed the Tax Cuts and Jobs originally, they adjusted the withholding tables, because what they said was they didn't want people to wait until, good, bad, or indifferent, I'm not taking a side, but they didn't want everyone to wait till tax time.
She doesn't like the IRS.
Right. They didn't want them to wait to have to reap the benefit of the lower tax rate. So what they
Right.
said was, you know what we're going to do? We're going to withhold less. That way, because they're going to owe less. So we'll withhold it less throughout the year. So someone who's expecting a $1,000 refund, who had
Right.
that much less withholding this year, was in a different situation at tax time. So there was a reason for that. So that also is a reason, when you're working with an advisor, we can say, oh my gosh, look, your withholding is a little bit different. Do we want to change it right now? Let me project it out what it should be to get to where you want it to be.
Well, that's another reason why you should work with a CPA, especially if you're an investor, is if I got to pay ahead on my tax liability.
Right.
I sold the security. I made 10 grand.
Yeah, because sometimes you do and sometimes you don't.
Right? And now, end of the year comes, I got all that money. I went on vacation. Yes, great vacation. You owe $3,000 plus penalties, plus interest, plus fees.
Yeah.
Oh, what happened? Right?
Right.
Just food for thought.
Any other tax credits you see that people are
Missing?
missing throughout the year, or because I know New York State has some in the alternative energy space nowadays?
I was just going to say,
and
most
stuff?
of the credits that are out there are revolving around clean energy, so solar improvements. I'm going to geothermal improvements to your home and things like
There's
that.
a lot now are outlawed though. A lot are illegal to do, which is like the geothermal and the solar. Like they don't even
really?
they don't even let you do them. Because I looked into it, I'm
I
like,
to
oh,
be
perfect
honest-
solar. They're like, yeah, you can't do it. I'm like, oh, what the heck? Like,
is not my
this totally
area.
sucks.
Whenever a client
I don't
tells
know.
me they did something, I have to look up in the chart, make sure it's exactly what they say, because I don't. But that's it.
It's just crazy.
That's probably the most prevalent one. There are still some credits left for doing things like replacing your windows or
Windows,
doors and insulation,
furnace,
making
yeah.
them a little more energy efficient. And those probably get overlooked. It's a couple $100s, but still.
Yeah.
But it makes a difference.
Yeah, it sure does.
Yeah.
And one of your other areas you were saying is specialty that we had talked about a little prior is also with nonprofits as well. You want to talk a little bit about that and
Yeah,
why
we have-
nonprofits may want to come to UHY to
Sure.
pursue that.
Thanks. Yeah, we have a big nonprofit client base. Proud of that actually, because I really enjoy our work with our nonprofits. But
cool.
New York State, doing business as a nonprofit in New York State. New York State has, of course, said, well, listen, if you're going to have a certain level of revenue, we're going to require an audit. So that's not my area of expertise, but and then of course then you have to file your tax return. So we work closely with our audit team once they're done with an audit to prepare the tax return. And a lot of nonprofits, the same thing. People think like, oh, nonprofit, no tax, who really cares, right? Well, the nonprofit tax return is 12 pages long with a minimum of 4 to 5 schedules, giving
It's
lot
a heavy
of
lift.
detail. It's a very heavy lift.
It's a heavy
lot
lift.
of detail about
For
what's
what
going
people-
on.
For our listeners out there, it's like you getting a report on a Friday at 3:00 and having to finish it, right? It's
Yes.
it's not fun.
I mean, nonprofits have some unique disadvantages, and that's of staffing a lot of times to
Right.
help
course.
them, send out the tax forms and statements that they need to clients, especially some of
Right.
the smaller ones.
And that's we find that a lot, particularly on our smaller nonprofits. And I feel terrible, right? Because
Right.
they're volunteers, they're passionate about what they're there for.
We're just trying to help the community.
And a lot of times they'll say, we'll ask them these technical questions, and they're like, "Listen, I'm here because I want to promote X, Y, and Z in my community, not
Right.
because I want to be answering you about
Right.
payroll tax questions." So, so we're sympathetic to that, obviously, and try to help as much as possible and make that as understandable as possible. But you're right. That happens a lot. They're not staffed with professionals because
Right.
they want
'Cause
to
they're
use their
volunteers.
funds on. Yeah, they want to use it towards their charitable purpose.
Yeah, they're usually pay scales, not here.
Right.
I'm the CEO of a nonprofit. I make $4 million. Like, wait a minute.
That's why it's no profit.
That's not a profit.
Yeah.
So what's the best way for people to get a hold of you? Obviously, you have a tremendous amount of information. I think obviously we want to refer people to you and our clients that are watching. So how do they get a hold of you? What's the best way?
Sure. Well, I am located in our Hudson office, like I mentioned. So first, you could just come to Hudson, New York, and have lunch on Warren Street. But so I'm
The train stops right there, by the way,
train
from
does
New York
stop at
City and
Hudson.
Rensselaer and Albany.
It does. It does.
Hudson.
But you can find me and my colleagues on our website, uhyadvisors.com. And in the Hudson office, do you want me to give my phone number?
Absolutely.
Okay.
Phone number and email.
Okay, here's my phone number. It's 518-751-3011. And my email address is twolfe, with an E, TWOLFE, at uhy-us.com.
Oh, with UHY
Dash.
That's the middle.
That's right, not the lower one, the upper one. US.com.
Great. Well, it's been a pleasure having you in today. And,
Thanks for having
as
me.
always, our listeners can find Diner Tree Financial at 43 British American Boulevard in Latham, New York, 12110. You can reach us at 844-444-YTYM for Your Time, Your Money. You can find links to all our episodes at yourtimeyourmoney.net for your net worth. And as always, it's your time
And your money.